Hello, everyone, and welcome to our webinar today with Tom Dixon and Larry Kotlikoff. My name is Alex Kotlikoff, and I'll be moderating today. We're really excited to welcome our friend Tom to our webinar series. I just want to give a brief background about Tom and then some information about what I'm going to be doing. Tom is a personal finance educator whose background in the reverse mortgage industry gives him extensive knowledge of the pros and cons of reverse mortgages, which is exactly what we're talking about today. So it's good that he has that background. Tom has 35 years of experience in many sectors of the financial services industry, including mutual funds, brokerage, trust, reverse mortgages, as I said, and fintech. Tom led the launch of one of the first online brokers and introduced one of the first multimedia education programs for 401k participants. And I just wanted to say a few things before we begin. Today's webinar is actually a webcast, which means you'll only be able to hear through your computer audio. If you're having trouble hearing, just let me know and I'll see if I can help you. Today's webinar is being recorded and will be sent out in an email along with the PowerPoint slides, so don't worry about that. After the presentation, we'll transition towards Q&A, which is going to be, I think, maybe like 1 to 2 hours. We'll see. It looks like Larry and Tom can kind of go on for a while today. Just please write your questions in the questions field located on your webinar control panel. I'll repeat the questions to them and we'll continue like that. We'll try to get to everyone's question, but you know, as always, we have a lot of folks today, and if for some reason we don't get to your question or you know, you need to, it's too long of a question for you to submit on a webinar, just feel free to email me at alex@economicsecurityplanning.com. And with that, I'm going to hand it over to Larry and we'll begin.
Thanks, Alex. It's a great pleasure again to be with all our Maxify customers and their friends and relatives and associates and for others who are new to our particular company. I'm delighted to have Tom Dixon as a guest. I can't think of anybody who knows more about reverse mortgages, but is also an expert in personal finance in general, and just a terrific person who I've known for a number of years now. So it's a real thrill to be able to have Tom do this with me. And what we're going to do is have Tom do most of the talking at the beginning. He's going to basically give you the ABCs about reverse mortgages, how they work, who's eligible, maybe make a few statements about interest rates and fees, and provide an example. Well, actually, I'm going to provide, well, he might have an example too, but, and then after he speaks for about 25, 30 minutes, I'll come on and tell you how one can analyze reverse mortgages using a Maxify planner. It's really extremely simple, and add a few comments to things that Tom said. And I want to and then we'll kick things off Q&A probably around 45, 50 minutes from now, and just go in as long as people have questions. The background for interest in reverse mortgage is this. I just want to say a couple words here about the background and then give it over to Tom. We have 10,000, think about that, 10,000 baby boomers retiring daily. That's a very big number. Half of these people have less than $50,000 in wealth. So my generation, I'm a baby boomer, I'm just kind of smack dab in the middle of the baby boom, has really failed to save. Now, there's lots of reasons that I can provide for that. A large chunk of our pay was taken away and continues to be taken away for younger workers in the form of Social Security and Medicare FICA taxes. So when you don't have much out of which to save, you can't really save that much. But I think there's also been the notion that the employer would save for us through the 401k. A lot of people didn't participate in their 401k plans and haven't accumulated a lot there either. Very few have regular defined benefit pensions where you hit retirement and then you get a check every month. State and local workers and union workers have that, but when I was a kid, defined benefit plans in the 50s were just every major company had them. But then starting, I think in the mid 60s, I think it was with IBM, they started transitioning from DB to DC plans to 401k plans. And over a few years, the major U.S. companies completely wiped out defined benefit pensions because they didn't want to have the obligation, the liability of making good on these pensions. And they left it in our hands to contribute to 401k and IRA plans and to invest the money on our own. And as a result, many of us haven't done a very good job. We also have pretty high Medicare premium, especially if you have a decent amount of income, a lot of out-of-pocket expenses, whether you're in traditional Medicare, particularly if you're in traditional Medicare, as opposed to Medicare Advantage, which is a growing part of Medicare, has about 40% of the participants. That's a little bit better in protecting you in terms of some of the expenses. Many people are taking Social Security far too early. That's putting them into jeopardy with respect to being able to sustain their living standard in retirement. Social Security's benefit taxation is growing every year because inflation is raising our Social Security benefit. We're getting these COLAs, and the thresholds at which first 50% and then 85% of your Social Security benefits are subject to federal income taxation, those thresholds are not adjusted through time for inflation. So effectively, more and more people are being taxed at higher rates, or a bigger share of their Social Security benefit is being subject to taxation every year. So for our case, for example.
Hey, I'm gonna just jump in for a second. Can you lower your camera a little bit, Larry? Because people are, yeah. Is that better? That's better. How about raise it a little bit more?
Raise
it.
This
Yeah, that's good. That's good. All right, let's keep it there. All right.
Okay. So I would just, on Social Security, the system is effectively bankrupt. So we don't have just a private retirement debacle, but we have a public retirement debacle, because if you look at the trustees report that was issued in April, Table 6F1 shows there a $53 trillion unfunded liability. That's more than two years of GDP. Social Security's in red ink, so it's effectively bankrupt. So we don't know how that's going to play out. And we have 2 in 5 retirees as it is living essentially entirely on Social Security, and or primarily in Social Security. So it's one of the two. So this might be a little bit of an overstatement. It's probably 20% are living entirely on Social Security, and I would say 2 in 5 are living either entirely or primarily on Social Security. So the trapped equity problem is that almost half of seniors' net worth is tied up in their home equity and in the value of their home minus the value of their mortgage. That's what we mean by home equity. The median home equity, it's not enormous, but it's $150,000, and that could certainly cover a number of years of your spending in retirement. Home equity clearly is higher for people that are older because they're paid off more of their mortgage. And as a result of the fact that people have so much of their resources tied up in home equity, they're house poor. And you can be house poor for one of two reasons. One is you're paying too much in property taxes. The house is always, something's always breaking, high maintenance costs. There's also high potential homeowners insurance. But you can also be house poor because you are unable to spend your home equity. I mean, imagine you're sitting in an expensive house, or relatively expensive compared to your basic income. And to make it extreme, suppose you had a $5 million house and you're living on $20,000 a year on Social Security, and you love your house. You under no circumstances do you want to move, and you can't access that $5 million of equity. Maybe it's completely paid off. There's no mortgage, and so you're kind of starving relative to being able to tap into that equity and raise your living standard for the rest of your days. So that's where I'm going to turn things over to Tom and let him explain the magic of reverse mortgages being able to help solve this problem. And let me just say that I've been a skeptic about reverse mortgages for many years. Tom knows this. And in preparing this webinar jointly with Tom and talking to other people and doing my homework, I've really come around to understanding that I had some mistakes in my understanding. There were some aspects of reverse mortgages that I was worried about that weren't actually true. And we talk about that more, but I'm now much more of a fan. I think it's really something people should look at carefully. The other thing to say is that the system of reverse mortgages, the standard reverse mortgages, are being regulated very heavily by the Federal Housing Authority, the FHA. So right away, you know that somebody from the government has been taking a very careful look for a long time now at how these reverse mortgages are structured. So this is not, the private sector trying to con people. The government is really very strictly controlling how these things work. And I think probably because of that, we can be pretty confident if you're getting what's called a HECM reverse mortgage, which is the standard language for an FHA reverse mortgage, that these things are trustworthy, that what you're being told is actually going to happen. So let me now turn things over to Tom, and I'll get back to you when he's done. And then we'll do the Q&A.
Great. Thank you so much, Larry and Alex. Great to be here with Team Kotlikoff, and I really have great respect for Larry and Alex and the team here. So it's a pleasure to be here. Let me just, if I may, tell you a little bit about myself, and I'd like to, I'm assuming, Alex, you'll make me the presenter, and I'd like to just give everyone start off with a kind of an introductory slide and then just add along. There we go, I think. All right. Let me just make sure everybody sees. Hopefully, there we go. All right. So again, thanks, Larry and Alex and everyone that's joined. Certainly appreciate your time and your interest in reverse mortgages. Just by way of, again, introduction, on the screen is actually my website for a personal finance education platform that I have. I encourage you to visit the website, financialexpertsnetwork.com. It's something that I have been hosting webinars like this with subject matter experts like Larry, and that's how we met probably about 11 years ago. I've been hosting educational webinars for both financial professionals and consumers or investors like you. So I encourage you to visit the site. While it's top of mind, the topics that I help educate people on include things such as reverse mortgages, Medicare. Larry mentioned Medicare. I've done multiple sessions on Medicare, Social Security, tax strategies, FICO scores, you name it. I've done a range of sessions. So anyway, I encourage you to visit the site. Certainly welcome you to take advantage of any upcoming webinars. And by the way, one of the things I want to make sure I mention, I am a baby boomer too, so I have a tendency to make sure I mention things while I'm thinking of it, else I forget. None of you can relate to that, I'm sure. But for any of you that would like any help post this session, after this session, you're welcome to email me at tom@financialexpertsnetwork.com. I'm happy to give you a second opinion on any reverse mortgage proposal or situation that you're looking at. All I would ask you to do is put in the subject line, friend of Larry, so I know to make sure that I can find your email and can associate you. So I would just add in terms, before we get into the specifics of what is a reverse mortgage, how they work, the pros and cons. My background, I spent about 11 years in the reverse mortgage industry, not as a loan officer, but as an educator. Similar to what my role is here today, my goal is really to educate you again on how this financial product works, what the options are, what you might want to think about if you are investigating this. I'm not here to sell you, to be blunt. I'm not a loan officer. I know lots of good ones throughout the country. But again, my role when I was in the industry, and I'm no longer in the industry, but my role was to educate folks like you, as well as financial professionals. And that was part of my specialty, was educating financial professionals on how this product works and their clients, folks like you, happened to sponsor some of the academic research that was done on reverse mortgages, dating back to 2011 and carried on. So again, I've been lucky enough to really become a student of the product and how it works, and maybe more importantly, how and when it makes sense. So let's start with very simply, what is a reverse mortgage? Folks have different definitions, and there are certainly a lot of myths out there. And I appreciate Larry's honesty in terms of it took him a certain period of time to really get his mind around how this works. And I think there are a lot of misperceptions. So let me again start with a definition that really a reverse mortgage is a loan that allows homeowners either 60 or 62 years or older, and I'll explain that difference as we go through the slides that follow. It is a loan that allows homeowners that are age eligible, either 60 or 62, to really gain access to the home equity that they have built up over the years or perhaps decades. So Larry uses that term trapped home equity or trapped equity. So if you think about it, if you have a home and whether it's paid off completely or almost paid off, you really, that home equity is really not doing you much. And the only way to really access that is to use a reverse mortgage or a regular home equity credit line, of course, or you sell your home. So what this does is it gives you a tool that can allow you to convert some of that home equity, and depending on your situation, possibly into tax-free cash. And that's and if you're making notes, that's one note I would encourage you to jot down, is a reverse mortgage. The proceeds of it are tax-free, and that's going to be an important factor for many. Now, some important facts, and again, these slides will be available for you post-session. I'm one that I like to make a lot of notes and things that you can refer to after. But let me start with number one. If you use a reverse mortgage, you still own your home, not the lender, not the bank, not the federal government. It's just like a regular mortgage in that if you use a reverse mortgage, to point number two, a lien or a mortgage is filed against your property, just like it would be if you had, again, a regular mortgage being a 15 or 30-year mortgage or a home equity line. It's the same exact concept. So the bank never owns your home when you put this in place. The only way they would be as if you, at the end of life, or let's say you weren't paying your property taxes and property insurance, that's point number three, then that's what would trigger possibly a default or a foreclosure. But generally speaking, I want you to understand, is if you use a reverse mortgage, you still own your home. That's absolutely how it works. Now, the fourth point is really largely where this term reverse mortgage came about. And it simply means that if you use a reverse mortgage to draw money out of your home, and we're going to talk about the different options that are available to you, you do not have to make any monthly payments. That's obviously a big point that distinguishes it from a regular mortgage. So it's sort of the reverse of a conventional or regular mortgage. Now, looking at the most common or most popular type, I'm glad that Larry started us off with the comments about the federal government, in fact, is really the insurer or the sponsor of what is the most popular type of reverse mortgage. So you hear that, kind of, I call it slang, the term reverse mortgages. Well, in fact, the true name of the most popular type of reverse mortgage is a home equity conversion mortgage, or HECM. HECM is the acronym, or HECM. And again, as Larry alluded to, it's been around, the product or the home equity conversion mortgage has been around for decades. It actually was authorized into law, if you will, with President Reagan in 1988. And again, so that was the inception of the home equity conversion mortgage program. Along the way, absolutely, what I think is really impressive is they continue to work on improving the program, they being the federal government. And by the way, to be specific, it comes with FHA insurance, and the oversight is provided both by HUD, right, as well as the Consumer Finance Protection Bureau. So there are government watchdogs that are watching over this this product and the conduct of the lenders and the loan officers. It's got extreme regulatory oversight. And again, there are improvements made that are put in place, and I'll talk about some of the safeguards, such as a financial assessment guideline. There are now guidelines that were put in place in 2014 to help ensure that if you were to use a reverse mortgage, that frankly, you're in a financial position where you can pay things like property taxes and property insurance. Said simply, they want to make sure you don't get in over your head, right? Overall, I think another thing that is important for you to know is, as Larry said, this is not sort of a, this has a lot of stability as a program, and I think a good metric to think about is the fact that over 1 million Americans have actually used a home equity conversion mortgage. So that's substantial, obviously. So again, we touched on what is a reverse mortgage. We now know that the most popular type is one that's insured or sponsored by the federal government. Let's touch on who's eligible to use a reverse mortgage again, and then what type of property. So as I had on the first slide for the 60 and 62, let me explain. For the home equity conversion mortgage product, if you're a couple, husband, wife, same-sex couple, right? No discrimination, by the way. One of you has to be 62 or older. The youngest of the two of you as a couple can be as young as, believe it or not, 18. Only in America, that's all I'll say. But again, one has to be at least 62 to qualify for a home equity conversion mortgage. So that's the federal government reverse mortgage. The other type of reverse mortgage that's available in the marketplace is a proprietary reverse mortgage that are created by lenders that are in the reverse mortgage business. They're either called proprietary or jumbo reverse mortgage. And I'll give you some examples of that again in the slides that follow. But with that product, it actually has a few features that are different than the home equity conversion mortgage. One being that, again, if you're a couple, only one of you has to be 60 or older. So the age requirement is a little less than what you have with the home equity conversion mortgage. And then some of the features we'll look at with the proprietary product, it actually allows you to access more money with higher value homes. Now, the types of properties that are eligible, if you own a single family home, that's an eligible property for, again, a reverse mortgage. A condo or townhome, as long as they are FHA approved. And if they're not, by the way, many of the lenders will work with your homeowner or condo association to get that approval. And that's a pretty neat thing. And then if you, for example, if you own an investment property, up to 4 units or apartments in the property, provided you live in one of those units, again, your property could be eligible for a reverse mortgage. Now, some other less common property types that may be eligible, I emphasize that, could be a manufactured home, for example, or a farm, provided you don't have a lot of acreage and it's not a working farm. So if you don't see your property type here, he's certainly happy to help you follow up if you have questions about eligibility. So that's a little bit again about the who, the what, the where, the types of properties, etc. Now, I think it's really important to understand that there are safeguards in place with this reverse mortgage program. You know, to me, you can see I highlight some of the points here that I think are really important. One, actually, I don't know of any other financial product that you can buy that, whether it's an annuity, a mutual fund, any other financial product in our country where it's a requirement, it's mandatory that before you can proceed with putting a reverse mortgage in place, you actually have to go through counseling with an unbiased third party who works for an FHA or HUD approved agency. I think that's a wonderful check and balance. So in other words, if you research this and you think, geez, I'd like to proceed, and you want to start through the application process, you will have to have what's typically about a 1-hour call with a third party who's trained in making in how this product works and making sure that you're aware of generally what you're getting into, to put it plainly. And by the way, on that call, you can, and I believe you should, have a trusted family member or friend, or even, you know, a professional in your life listen into that call. Now, and so if they have questions, they can participate along with you. Now, that's optional, but again, I think that's a wonderful safeguard. Some of the other safeguards that are there, I'll just touch on. You know, a lot of times, again, people worry about if they use this product and they take, and it's really helpful over the years or the decades, and you take a lot of money. You know, you're going to have one of two scenarios that happens. At the end, either you're moving into another home, or you pass away in your home, and you're going to have a loan balance if you've used a reverse mortgage. Well, there you have one of two possibilities. Either you owe less than what the home is worth, so there's a profit to be had. So if there is a profit, that profit goes to you or your children or your heirs if it goes into your estate, or you may owe more than what the property is worth at that time, right? So the home may be what's known as underwater, right? Well, if it is so again, you, on the profit side, that profit would go to you or your children. But on the deficit, or if there's a potential loss, that's where the power of this FHA insurance comes in, because the FHA insurance fund would absorb the loss. And that's one of the safeguards here. There are other safeguards. You can make payments if you want, depending on your options. Again, there are financial assessment guidelines. There is no prepayment penalty, by the way, if you do choose to make payments. And then there are, the fees are closely regulated by HUD as well. Now, let me just jump into three factors that actually determine the value, that's the amount of money that's made available to you. So oftentimes people ask, well, how much can I get? I will share some examples as we go through these slides, but let me just say the formula is largely based on, again, three factors. One, the appraised value for your home. So there is an appraisal. There always is an appraisal. And that will help determine, again, how much is made available to you. Two, that appraised value is multiplied by a percentage or a factor. Two elements that really drive that factor, that calculation, are the age of the youngest that owns the home. So again, if it's a couple, the youngest, that's what will drive that percentage or that calculation, and the interest rate. So again, there's a percentage, as you'll see, that's multiplied by the appraised value. By the way, you'll see on these slides that the older you are, the more you qualify for. So there's yet again another benefit to growing older and wiser. So here's a good illustration of that. So in this example, we assume that there's a 62-year-old and an 80-year-old, right? And we assume for both that they own, and again, this would be the youngest client. If it's a couple, it could be a 62-year-old whose spouse is 70 years old, for example. Again, that would be calculated on the age of the youngest. So in this example, the 62-year-old would qualify for, as you can see under the row, available money, $205,200. Now, this is before the initial fees, and I'll explain that in a minute. So that on a percentage basis, you can see that's 51.3%. And again, that percentage will go up and down based on what? Everybody that's listening closely, you can respond in the chat room and say, based on age and interest rate. So this client, again, at 62, qualifies for 205,200. And you can see the 80-year-old, as an older client, qualifies for the 248,000 even, and that's 62%. Now, in both cases, there is an initial fee, and largely it's your standard title insurance and closing fees, but the majority of that fee is an FHA mortgage insurance premium that you have with that home equity conversion mortgage program. And it's 2% of whatever the appraised value would be. So again, that's the bulk of that fee. Now, you do not have to write a check for this. You don't have to come out of pocket. You can actually put it on a loan balance, which you can pay down at any point in time if you want or not. You don't have to, so it's your choice. But what happens with the bottom row, the net available money, will be take the 205, 200 for the 62-year-old, net out the fees. That's what gives you that net available money of 191,763, right? So again, that's how much money. I'll call it a pot of money. That's a really technical term. I'm kidding. That really is, you might think about it as your pot of home equity in that case that you have to work with. Now, this slide simply illustrates for that same 62-year-old moving left to right with these three columns, the impact of different interest rates. So on the bottom row, you'll see the row that I have where I have the percentages highlighted in green. Those are the different interest rate choices available to this client. And I want to make one point. There are a few things that I really get across today. One is, for any of you that are looking at a reverse mortgage, you always want to make sure you look at multiple interest rate proposals or options. So each and every lender has a range of interest rates that they can work with. And what will vary largely are two things: the amount of money that's available. So again, as you can see in the column on the right, if you have a higher interest rate, in that case 3.57%, you'll actually have less money in that available money. Again, that second row, right? 172,400. Now, the trade-off usually is, and it's not as dramatic or not as advantageous in today's low interest rate environment, but your initial fee should be a bit less if you agree to a higher interest rate. So again, the intent of this slide is just to simply illustrate there are choices for you, and those choices largely revolve around the interest rate. And most of the payment options come with a variable interest rate. There should be a cap on how high your interest rate can go at any time over the life of however long you have that in place. Typically, it's 5%. So you might start low, like in that example of 2.32%. But if you have this in place for 30 years or 300 years, it doesn't matter. Your interest rate with most should not go higher than the 2.32% plus 5, so that would be 7.32%. So again, you want to look for that cap as well. All right, so again, that's a bit about the options, and again, I want to make sure you're a good shopper if and when you look at this. Now, what I want to talk through or what I've seen is the common uses, and at the same time, I'll give you an idea of how this product works. Some of this may surprise you. One idea being that using a reverse mortgage to pay off a conventional mortgage. Absolutely, I've seen a lot of that. Depends on how much home equity you have in terms of whether that's possible. Certainly, you can draw a lump sum out. That's an option. You can buy a home. That was a big surprise to, I think, Larry in doing his homework again. And then you could draw a monthly check. If you draw, again, a monthly check, a lump sum, any money that you draw out in that form, it's all tax-free. And again, I'm going to move quickly through a few of these slides. Some of the benefits I sum up, these are some of the use cases that I've seen or how I've seen people use a reverse mortgage. One, and things from delaying Social Security, which Larry advocates, and I generally support that idea as well. You want to hold off as long as you can. And by the way, I've helped clients, financial professionals model hundreds and hundreds and hundreds of cases using software like Maxify, great program, and to really prove what makes sense or not from just a quantitative perspective. But one of the things that's not always obvious, if you are drawing a lot of money out of your IRA or your 401k and you're incurring perhaps unnecessary taxes, a reverse mortgage can help you, one, reduce the amount that you're drawing down out of your retirement accounts, your IRA and 401k, and two, in doing so, it can help you reduce your tax bill. And that's an important benefit. So again, any cash that you draw out from a reverse mortgage is tax-free. And again, that's not always obvious to many. So I hope you keep that in mind as you're evaluating. So this is an example of an actual 68-year-old couple, actually from New York, own a home that was appraised at $970,000, still at the age of 68, making a pretty serious monthly mortgage payment you can see on the third row, $3,387, 47 cents a month. You know, their mortgage balance was $366,324. So if they had about 20 years left of payments. That's a long way to go. If you just do the math, take the monthly payment times 24 times 12, 240, right? You're gonna have a lot of payments. What's available to them is the fact that they could actually get rid of that monthly payment, so that money they can use for other purposes, no restrictions there. And at the same time, so that's number one, they get rid of those monthly payments. Number two, because they qualified for more than that $366,324, the additional money that they qualify for, they can put in a credit line with the reverse mortgage program, with the home equity conversion mortgage credit line, that they can access if and when they want. They never have to. Now, again, a consideration, and one of the things, again, I want you to all be aware of, you want to think about, and this is why, by the way, I feel very strongly, you want to make sure if you're working with somebody, and again, if you need help around this, I'm happy to do it. You want to make sure that you have someone that's really giving you solid advice, looking at factors such as how much will your loan balance be in 10 years in this example, or 20 years. And by the way, that number is if they use a reverse mortgage, right? So you want to contemplate things like this because you want to make sure if there's another move in your life, if there's a next phase, that you have enough equity to really have flexibility in terms of where you choose to live, right? So that's one example. Again, if you have an existing mortgage, a conventional mortgage, generally if you have, I'm going to say 55% in home equity or more relative to your value of your home, and you're 60, 62 or older, right? You could qualify for that scenario. Now, another common use, let's say you don't have any mortgage and you have that $400,000 home, and that's what this example is based off of. Again, if you're 62 and you look like that baby boomer, right? Hopefully you recognize them. And you would be able to draw on a monthly basis a fixed amount, $803 again, every month for as long as, if it's a couple, one of you lives in the house. So that could go on for 20, 30, 40, 50 years. And if one of you were to sadly pass away, as long as the surviving spouse remains in the house, that payment continues on. Now, again, just to compare and contrast the difference in payment amounts, for that 80-year-old couple, the payment amount would be $1,403 a month. So again, the older you are, the more you're going to qualify for.
Tom, let me interject with a couple questions or comments.
Sure.
So, because I want to make sure everybody gets everything. So, if you take out a reverse mortgage, so unlike taking out a regular mortgage, you have to immediately start paying back principal plus interest. But here you don't have to pay back anything, but your loan grows. If you, for example, don't pay any fees, the fees plus the amount that you're getting, whether you can get money in a lump sum or you can get money over a fixed amount every year for a fixed number of years, or you can get money coming as long as you continue to live. That's an annuity. It could be a single annuity or a joint annuity, joint survivor annuity. So Tom is kind of telling us about, in effect, indirectly telling us about three ways you can get out your money. You could get it in a lump sum, you can get it in fixed payments for a fixed number of years, or you can get it as long as you and even your spouse live. Now, how much you get is going to depend on how you take it and also the prevailing interest rates. So there's that, but then there's also this loan balance, which whatever money you get out that you take is going to be accumulating up at this interest rate. Now, Tom, correct me if I'm wrong, but if you take out a fixed payment, a one-time fixed payment, lump sum, the interest rate is fixed on the so that amount that you owe is accumulating at a fixed rate. If you're getting out money on an annual basis, then the interest rate that's being charged on the loan is variable, and that's where the interest rate could go up by, you said, 5 percentage points. So now, why do we have to be concerned about this? You know, we're getting money in, that's the good part. The bad part is, well, they're not giving it to us for free because the money that we get in, they're accumulating, and as well as the fees, if we haven't paid them, are accumulating at interest. And then whenever we move, we might have to move at 80, or, let's say we're 62, we do this, might have to move at 80 to move with our kids, go into a nursing home, an assisted living facility. So at that point, we have to sell it, or we might die. At that point, the house gets sold. As soon as the house gets sold, the reverse mortgage company has the first claim. And they say, okay, you sold the house for X, but you owe us Y, and you get to keep X minus Y. Now, one of the things that Tom was saying is that if you live long enough, you stay long enough in your house, well, the Y that you owe, the amount that you got accumulated at interest, could exceed the value of the house, in which case, when you pass away, when you move, the lender, the reverse mortgage company, is going to grab the entire house. You won't have to make up the difference. Your heirs won't have to if you're dead. So you've actually been living in somebody else's house, the lender's house, for free, rent-free. And this is an insurance value to you, because if you're long-lived, if you have this long longevity, a great longevity, which is a risk, obviously, and if the longer we live, the longer we have to pay for ourselves. So if we live longer, and we're also able to stay in the house, then we have this extra kind of insurance kicker from this particular security, because at some point the lender owns the house and we're living rent free, and we could live till 150 and not have to pay a penny. We have to pay maintenance and property taxes and insurance, keep up the place. But apart from that, we don't have to pay rent to the owner of the house, which is now the lender. So that's an insurance. And then the other thing is, if we take the payments in the form of annuity that continues to, a monthly payment that continues as long as we live, that's also insurance against outliving your resources. So the reverse mortgage has two insurance aspects to it, but there are risks. I mean, if interest rates go up, and if you end up having to move, after 15 years, a good chunk of your house might end up in the lender's hands, not in your hands or your kids' hands. So your next move may be tricky. You may want to buy the same kind of house in a different place, and now you're kind of short of cash because the equity you had in your house, you had to hand over to the, or some good chunk of it had to be handed over to the lender. So let me just say this one last thing, which connects to what Tom just said, which is, suppose I had like a $400,000 house. I'd like to live in a $400,000 house for the rest of my life. I don't want to go and rent. But I only have, after paying off the reverse mortgage, my first reverse mortgage, I only have $200,000. So I can't buy a $400,000 house with $200,000. If I go to the bank at age, let's say 80, and say, Lee, gee, lend me an extra $200,000 on a conventional mortgage. Here's my down payments, 50%. They might say no, because you don't have a standard income. You don't have a regular income coming in. But, and here's the key thing that I learned from Tom just yesterday, you can take out what's called a HECM purchase loan, which is it's not a conventional mortgage, but it's a reverse mortgage where you'll get the extra $200,000 from the HECM lender, and you'll be able to buy the house. And then again, you won't have to make repayments until you have to move again, or you may, if this is your last house, that would happen when you probably pass away. So as Tom said, you have to kind of keep an eye on where things are, what's your reverse mortgage balance, what might happen with respect to your moving, and maybe you'll move and rent. So you'll take your $200,000 and just use it to rent, and that'll be the end of your trapped equity problem. So there's more than one option here for continuing along the path, but you want to be aware of A, what you're getting in, and also B, what you're getting back. And Tom, did I say it correctly about if you get a lump sum, the rate is fixed, and if you get a variable, if you get a stream, the rate is variable? Or, sorry,
Right.
If you get a stream, the repayment is variable, the stream is fixed. in nominal dollars, and it's subject to inflation, could reduce its real value. That's another important thing to risk that we'll have to worry about. But I want to make sure that the repayment was fully characterized.
The loan balance grows. So depending on the payment option, right? If you have a fixed or a refinance situation like that, it's a fixed interest rate in terms of what's used to calculate your loan balance. If you're taking a monthly payment or you use the credit line option, that's where the variable interest rate comes into play. So great segue. This example, what's on the slide is from a calculator, an Excel workbook I created that to really help people analyze. This is the same scenario where that 62-year-old is drawing $803 a month. And what I'm showing, top row is a very conservative, and I tend to be conservative like Larry, the home value and what that appreciation might look like at different ages going forward. But second row, what the loan balance would be given that draw that the 62-year-old is using. And then here's the key point, what I have highlighted, that net home equity. So if you look at age 82, again, the home, assuming it's worth a little over 538, the loan balance is 321. If they were to sell at that time, they would have, before closing costs, et cetera, 217,000 plus in home equity. So what I put together here, based on chatting with Larry, is a situation that shows, okay, if that was to transpire, what options are available to you? And I think this is important to consider. Again, I think that previous slide, and by the way, I'm happy to share that little Excel workbook that I came up with. Again, if you want to email me, I'll put that up again. Happy to share that with you. I definitely think you need to have somebody coaching you through that. But what we show here is the idea that, so let's say you sold that home, it was $538,000. That was transaction one. You net, assuming 6% closing costs with commission and any transfer taxes you may have, you net $185,263. So that's from the sale of your family home, let's call it. Now, at age 82, you have the ability to buy, guess what? A condo, I'm just as a scenario, right? And the purchase price is $400,000. As Larry alluded to, with the HECM for purchase, you're actually able at that age, in today's environment, borrow $252,400, right, to finance the purchase of that condo. You would take $161.37 from what you netted from the sale of your old home. You now are moving into a place that's a better fit for you, most likely, right? You have no payments required, and you have a little leftover cash, as you can see in this example, of $24,000. So that's just, again, one scenario where if you think about the options that may be available to you, that's one. Or if you're looking to buy a home, again, I'd encourage you, just like any use of this, I just encourage you to think about it. Now, let me just walk through a few other slides just in a few more minutes here. This is yet another payment option that's available. So in addition to that monthly payment, you could choose to say, you know what, I'd like to just put a credit line in place. I don't think I need that monthly payment, but essentially I'd like to have access to money if and when I ever need it. Again, for that initial cost of $13,437, you would start with $191,763 at the age of 62. What these bars are illustrating is the fact that the amount available in that credit line, other than way different than a conventional home equity line that you get, right, a HELOC, the amount available will grow month over month, year over year. It's formulaic. It's absolutely in the loan documents. It's prescribed by HUD and the FHA. This is exactly how it works. So in this scenario, the client, you perhaps put this in place, $400,000 home value, you start with that 191. At age 90, you say, wow, I now have a line available to me at $434,024. And let's say, by the way, it has no dependency on what happens to the value of your home. In fact, I could cross that out to $400,000 reference and say the home is worth $1. You could actually call up your lender and ask them to send you a check or deposit a check into your account for $434,024. So this is, I've seen many use this as a hedge against, it could be if you worry about your investments go up and down and you'd like to have another resource to draw upon when that happens, and that happens on a regular basis. Long-term care, the ability to stay in your home, absolutely a great proactive hedge, or just a decline in property value, right? So if you think about, if you look at the number of the 13,000, and even over, if you look at age 80, basically the line has grown by almost a factor of 10 in terms of what the initial cost is. So again, this is a credit line. This is yet another option.
So
here's just a simple sum. Sure.
Tom, maybe just pipe in here, and then probably we'll have to wrap you up and have me talk because of the time, but it went on a little bit longer, probably because of my interruptions. But if you could just take it back to the prior slide for a second. I just want to say what you said in a slightly different way, because this is like the third kind of interesting insurance aspect of this HELOC. What Tom's talking about here is putting some money down, not a trivial amount of money, in this particular case, $13,000, and you get a line of credit. You get the opportunity to borrow in the future. And you say, well, why bother with that? You know, why not just wait 20 years? If I need to borrow money on my house, I'll just borrow at that point. And maybe you're not interested in getting any money from a reverse mortgage. You're liquid. You're not, but you're keeping the home equity as like a reserve fund to get into a nice nursing home, or to deal with end of life healthcare costs, or maybe even to give the house to your kid. Now there's a risk, okay, that this thing deals with for the $13,000, which is, suppose you have a really nice house, it's worth $400,000, and then your neighborhood, a bunch of criminals move into your neighborhood, or the town runs a highway right across your road, or they discover that your neighbor's got a toxic waste dump in their ground. Now all of a sudden you can't sell your house. It's gone from $400,000 to nothing. But if you have this line of credit, you're able to borrow with no repayment until the house is sold. $434,000. That's of course in nominal dollars. And if you said there's going to be 1.5% inflation, it'd be more like $270,000 in today's dollars. But anyway, you get something. You're getting insurance against your house price dropping. That's what I want you to get across. You know, this is, and again, Tom and I don't sell these products. We're not here to try and sell you on reverse mortgages in any way, shape, or form. We have no relationship we get no, you know, if you buy a reverse mortgage, don't buy a reverse mortgage, makes no difference to our incomes. So we're not here to do that. I'm just trying to get across the insurance value of this particular thing, which is even if you don't want to deal with a reverse mortgage in terms of getting money out and having this loan balance grow and then worrying about how much equity you'll actually have if you have to move or if you die, how much the kids will get. But if you're worried about protecting that value of your house because you're going to want to use that to give to your kids or to get into a decent nursing home or pay for these costs at the end, then this is like home price insurance. And that's worth taking into account. Anyway, Tom, why don't you spend a couple of minutes more, and then I'll show some examples with Maxify. I hope people are able to stay on.
Sure.
If not, we're going to provide both sets of slides, my slides, Tom's slides, and the webinar is going to be posted. The Q&A is going to be posted right at maxify.com/webinars, and also on Tom's site, I presume. So.
Yeah, absolutely. Okay, let me just finish up. I would just say this slide simply you want to make sure, again, if you're looking at a reverse mortgage, you look at all the payment options available to you. That's what I'm summarizing on this slide. Again, that monthly payment, credit line, lump sum. You could actually get a monthly payment for a fixed period of time. So again, you have a lot of flexibility. Here, this is yet another example of that purchase idea. I let this in because it shows what's available for a 62-year-old. So again, that's going to be less than that 82-year-old example we used. And then I wanted to just get this up because I know we had someone in the question panel post, if you live in California or states where you have high value homes, that's where, if available, you want to look at, and I know they are in California, you want to look at the jumbo or proprietary product, because you will be able to access more money, because with the home equity conversion mortgage, there is what's called a lending limit, meaning you could use a home equity conversion mortgage if you have, in this example, a $2 million home, but the percentage or the formula is always based, it's always calculated by the lesser of the lending limit, which is $822,375, or your appraised home value. So in this example, that's what applies, not the $2 million. So you're not able to tap into additional money, much like you would be with a jumbo or proprietary product. And by the way, also the jumbo or proprietary products don't have that 2% FHA mortgage insurance premium. They are not FHA insured. I think personally they're still a very safe product. So there are pros and cons, especially if you have a higher value home. These are the four nevers that in the industry are pretty common. I'm just going to encourage you to kind of read through these. We've touched on some of them. By the way, just one clarification. If in fact your home, you've used a reverse mortgage for decades and the amount that you owe is more than the value of the home, let's say the home is worth still $400,000 and the amount due at the end of life and is $600,000, just using an example. If you pass away and it goes into your estate, your children can actually buy the home for 95% of the then fair market value. It's really an incredible, hope it doesn't happen this way, but it's an incredible option for those children that would want to buy the home. So let me just leave you with, again, here's my website. I think I'll put my email up again. I encourage you to, by the way, we have, again, lots of other content that I think would be of interest to you. I'm just starting a Facebook group. If you're on Facebook, if you're doing that, feel free to go to the group Retirement Questions with Expert Answers, and just ask to be added to the group. Happy to have you. Again, I'm going to get that off soon. Little quote from a leading retirement researcher, Wade Pfau, very well respected figure in the retirement industry and the financial planning industry, has a book. If you really want to go deep, it's a very analytical book. I encourage you to look at that. And then again, last but not least, I'm happy to try to be of help to any of you. There's my email, tom@financialexpertsnetwork.com. We can certainly post that in the chat room. And with that, Larry, thanks so much. And sorry if I ran a bit over, but thank you. I'll sit and wait for a Q&A.
Thank you, Tom. So Alex, you're able to have me share my screen?
Absolutely. Yes. Let's make you the presenter.
Okay, here we go. Okay, so I'm just going to pull up my PowerPoint here. And so I prepared, being a good professor like I am, I prepared a lot of things for people to read. So I'm summarizing a lot of what Tom said, but in the lingo of economics or of an economics professor. So you get to read it in two different ways. And I think seeing it from two different angles, you'll come away with a pretty full understanding of what's involved. So I'm just going to kind of flip down and, and this is just going through all the, talking about, for example, the types of fees that you're facing that are not trivial. So this is, but you'll see the bottom line, which is how do we actually enter or model a reverse mortgage in Maxify? It's actually extremely simple. And, when all the words are said and done, or when we've heard all the words, some of which are kind of confusing, the real key thing about what's going on here is that there's money in and money out, right? If you engage in a reverse mortgage, take one out, you're going to get some money in over some time period. Might get everything in right away. Might be through time. There might be some downside risk insofar as the money that you get in might be risky in the sense that if it's coming in gradually, it might be, since it's coming in nominal terms, inflation may erode its real value. So you can certainly run scenarios, alternative profiles in Maxify that consider higher inflation rates to think about that. And then there's also the repayment. So the money that's coming in, you want to treat as a special receipt. It's not taxable, as Tom said. It can be either lump sum, one time, or annual. Continue right up to your maximum age of life if you're getting it really as an annuity. And the money that you're going to be paying, you want to enter as a special expense. Now, if you're going to, if you want in one of your profiles, your base profile, that you're never going to, never move until you die, and that you're going to die at your maximum age of life, then you can model this as just a special expense that you're that you have to pay at the end of your life. Maxify will know to use the value of your home at the very end of your life to cover that last special expense, and it'll show that the net estate that you're leaving to your heirs will be smaller. And if the value of your home at the end is less than the mortgage you're going to own, then just put this special expense equal to the value of their house, and then the net balance that your heirs will get would be zero. So that's really simple. It's just kind of expenses and receipts. If you're going to move, again, you'd set up an alternative profile. So I'm going to move it. Let me consider moving 15 years from now. I'm going to enter the proceeds as nominal receipts if they're coming in through time or just as a lump sum. I'm going to specify the moving date, and then the repayment. Well, the reverse mortgage lender would tell you, again, what you really want to ask is how much am I getting in, and how much am I, under this circumstance, paying out? That's really, at the end of the day, that's all you really care about. You don't really want to bother with so much the details of these programs as, well, some of them are important, but this is the most important thing, what's coming in, what's coming out, and that's special receipts and special expenditures. And there's a little bit more information about this here, but I want to just take you through a simple case based on some inputs that Tom gave me. It's about Jim and Sharon. They live in Massachusetts. They're 63. They've got $500K a combined, $250 each in a 401K. They've got a $350,000 house, no mortgage. They each collect $2,000 from Social Security a month, and they've got $7,500 in housing costs. If they take out their payment for the next 38 years, well, 37 years up through the maximum age of life, 100, they will be collecting in nominal terms $83.50 per year from this reverse mortgage. So that's basically the special receipt. Now, let's forget about the reverse mortgage for a second. Let's just suppose they could sell their house today and just rent it back at their carrying cost of suppose they could rent it back at $750 a month, and with a rental going up with inflation, because that's what would likely happen, 1.5%. How much would their lifetime discretionary spending go up? Well, it's a $350,000 house they own outright. Their discretionary spending on a lifetime basis goes up by $321,000. It's not $350,000, because what happens is that when they get this money, they invest it, and we're assuming they invest it safely, but the nominal interest is subject to taxation. So that's why this number is not as large as $350,000. Now, the problem with doing this is that A, you can't probably rent back your own house, and B, you can't rent it back for sure for 37 years. Well, rents might go up faster than inflation. Your landlord might evict you, and you want to have that stability that you lose by renting. So this may not be the option you want to pursue. So what happens if you do this reverse mortgage? Well, your lifetime discretionary spending doesn't go up by $321,000, but $251,000, and that's less because of a couple reasons. You're not allowed to. There's a limit on how much you can get out from your reverse mortgage. as Tom was indicating. And then you also have to pay fees. And then the interest rate is higher than on a conventional mortgage because of this longevity insurance that I was telling you about. Again, if you live to 150, at some point, not too far off in the future, the bank or the other or whatever lender it is going to own your house, and you're just going to be living there rent free. And that's the sense in which this is providing insurance, longevity insurance, and that's why the interest rate has to be higher. So 251,000 is still going to raise your living standard compared to the base plan, which is just sitting in your house and dying with your house, dying with that 350,000 trapped in the house. So that's a pretty big increase. 250, it's like a 20% increase in your living standard, if I got my percentages right, from doing this. Now, the last thing I wanted to show you, and then we'll do an open for Q&A, is what happens if the couple has to move at 82? They have to pay back, they've not paid a penny back on this money that they got out. It was 8,000 plus per year, but now at 82, they have to move. And suppose they know all along that they're going to have to move at 82. Does this still make sense? And let's suppose that they, at that point, decide to rent, which is not an unreasonable thing. And if you rent now, you have no trapped home equity whatsoever. They could, as Tom and I discussed, take out a HECM purchase loan and get into a house, and even if they have less cash to make, they can't make 100% down payment, but they can get a loan through this mechanism, which they wouldn't otherwise be able to do. Well, here you go. Their increase in discretionary lifetime spending actually is bigger than 251. It's 271, and that's really reflecting the fact that the renting at this point is making sure there's no trapped equity. So if you really do want to spend your trapped equity, but you do want to stay in your house at least for a pretty long amount of time, the reverse mortgage may be your answer. And if you are keeping just to repeat, if you are keeping your home as a security blanket, you want to make sure that the price doesn't drop. And that's where that HECM line of credit, which I also discussed, and I also discussed some other ways to deal with, trapped mortgage, trapped equities as well in this 30 or so slide doc, which you'll be getting. So I do think that for not necessarily for everybody, but for a lot of people, reverse mortgage may be an answer, and for others, the line of credit might be the answer, and for some, both of these things might be the answer, because doing one doesn't preclude, or doing one to a certain degree and line of credit to the rest of the degree may be the very best way to proceed. So let's stop here, Alex, and open things up for questions. And I'm sorry things have gone on, but this is an important topic, and want to make sure we covered it fully.